In this video, we will look into the fundamentals every mortgage shopper should know while shopping for a home. It's all about timing and doing the right things in the right order. We'll show you everything you'll need to begin on your path of homeownership. If you are searching the internet for a home to buy, you are most likely asking yourself, how much can I afford? First step is to make a personal budget. What you consider a comfortable house payment may be very different from what a mortgage lender considers to be a reasonable. The mortgage lender calculates your debt-to-income ratio, known as DTI, by adding up the monthly payments of the debts listed on your credit report and then dividing this by your monthly income. There are 4 key steps in the mortgage process from a borrower's perspective. 1. The application, where you meet with a loan officer and receive a loan estimate. 2. Processing, where you collect all the documents. 3. Underwriting or the loan decision. And 4. Closing. This is where all the money is paid and the house becomes yours. First step, you'll meet with a licensed loan officer and fill out the Uniform Residential Loan Application, referred to as URLA. The mortgage lender will determine the purchase price range you can afford based on the funds you have for a down payment, your debt-to-income ratio, information on your credit report, and other important factors. Your credit report will be run to see your debts and credit score. A good loan officer has you bring copies of your relevant paperwork like pay stubs, bank statements, and W-2s. You will also get a loan estimate that details all the closing costs. This might be surprising, so make sure your mortgage lender talks to you about the various methods of reducing the closing costs. Options could be the home seller paid closing costs, the lender paid closing costs. Also, if you have 20% down, consider paying your own taxes. Waiving an escrow account for taxes can save thousands at closing. Processing is when all the required documentation is ordered and collected to submit the loan to the underwriter. The appraisal and a title check will be ordered along with other documents related to income, employment history, debts, and assets. Many companies have moved to direct verification of income with employers and obtain bank statements through electronic services. They will need your written approval to go this route and can save you time in an easy and secure process. Underwriting is when your loan is reviewed for approval by the mortgage company, based on the product type shown on the application. There are different underwriting requirements for each product. Some of the many products available are conventional, fixed rate, Veterans Administration, Federal Housing Administration, USDA, Housing Finance Agency, and bond. Tell your mortgage lender upfront that you want a full pre-approval. This means the underwriter has actually reviewed your loan documents. Read the fine print on your pre-approval letter to look for any disclaimer that indicates pending underwriting review or approval. If you see a disclaimer, it means you only have a pre-qualification. It is important to note that most mortgage lenders use automated underwriting systems, or AUS, to analyze whether the loan meets the guidelines specific to the product you have applied for. An AUS approval will be used to issue pre-qualification letters. An AUS approval is not a full underwriting approval. Closing is when all the funds have been paid to cover the purchase price by the mortgage company. All closing costs are paid on the final closing disclosure, and the deed is transferred to you. One thing to think about in this process is how important a quality mortgage lender is, and making sure they work with many loan types so they can find the best option for your situation. Fixed-rate loans have the same rate and monthly principal and interest payment over the life of the loan. Adjustable-rate mortgages will have a change in the interest rate at different points in the loan and typically start at a lower rate than a fixed-rate loan. You can also take a look at monthly payments for a 30-year term, 20-year term, and 15-year term. The slightly higher payment brings big savings over the life of the loan. It is suggested to compare the monthly payments of a conventional loan with an FHA loan if you have less than 20% down and aren't eligible for a VA loan. You can buy a home with as little as a 3% down payment, but will need mortgage insurance. The interest rates between conventional and FHA will vary, and so will the mortgage insurance costs. Ask for a comparison between the two when you have a lower down payment. If you are eligible for a VA home loan, be sure to consider using this benefit. The VA loan allows 100% financing and lower closing costs. The VA funding fee is reasonable for a first-time user of the benefit and can be rolled into the loan amount to save out-of-pocket costs. Also, USDA loans are zero down payment and not just for rural areas. Here are the top 10 things you can do to avoid common pitfalls. 1. Run one free credit report from annualcreditreport.com before you start making offers on a house. You are entitled to one from each of the 3 bureaus every year. 2. Resolve any errors on your credit report in advance. It's best to have these cleared up before you make an offer. If you saved one of your free credit reports checks, use one to confirm the error is corrected. 3. Create a budget and stick to it. You'll want to save for the down payment plus at least 2 monthly house payments as a cushion. 4. Get a full pre-approval, not just a pre-qualification, to avoid having your offer rejected or worse, overlooked when trying to buy your home. 5. It's always better to have at least a 2-year work history with your current employer to present to your loan officer, so try not to switch jobs right before you start the process. 6. Research the property taxes in the markets where you are considering buying. Your annual property tax bill will be divided by 12 and included in your monthly payment for qualifying, even if you pay the taxes on your own. 7. Know if there are homeowners association dues, HOA dues. These must be included in your monthly mortgage payment for qualifying. The amount of the HOA dues can really change how much of a mortgage loan you can qualify for. 8. You can shop early for homeowners insurance and know if flood insurance will be required. 9. Select a loan officer based on referrals from people you know and validate their credentials through internet resources. Develop a circle of trusted advisors who have your best interests in mind. And 10. Expect constant communication from your mortgage lender. A good lender keeps you updated throughout the entire process. You should know the important milestones, when the appraisal has come in, when all the conditions for closing are cleared, and that you will close on time. To get the best mortgage, you will need to do some legwork to get the best deal. You've got this. Home ownership has many rewards. Begin your journey of building equity and establishing roots in a community by contacting a Union Home Mortgage Loan Officer today.